Hi, it's me, RP. We are in a period of economic upheaval. Money is important as riders would like to continue being able to ride our rides and still know whether we have money left over for the really necessary things in life, like 菜本. All of us like buying bikes, new or used, and would have probably at some point when buying a motorcycle encountered the question of whether we should finance our motorcycles or save up and buy it outright in full. As with all financial decisions, the logic behind taking a loan out on your motorcycle is very dependent on circumstances, and I cannot give you a simple yes or no answer. So let's run through some of the finer points and weigh your situation before deciding. In almost every situation, financing a used motorcycle is always a bad idea, and you should almost always save up to buy them outright. If you don't have enough liquid assets, aka cash on hand, to buy them in full, you probably cannot afford that motorcycle to begin with. This is because motorcycles are almost always depreciating in value the moment they leave the showroom and are worth almost very little, and you can find out how much its scrap is valued at by just asking an insurance adjuster. Dealers selling you second-hand bikes will almost always have to tack on more to the selling price to account for business costs and profit. If you finance the bike, the used bike, you are just paying extra interest on a motorcycle that is worth far less than what you will pay in full, compared to financing a brand new bike where the final amount with interest is often not much more than the actual value you get out of the bike when you first got it as a rider. Also, used bikes generally already have a pretty fixed price, unlike the fluctuating COE rates of buying a brand new bike. The used bikes already have a COE applied to it, and the price is already decided. You don't have to worry that passing on buying the bike this month will cause prices to jump up the next. And in fact, the same bike will just keep depreciating and lowering in value as time passes. So it is often better to just wait till you have the money to buy it outright. You need to account for inflation and the future cost of a bike. If you were to look at the Consumer Price Index of Singapore for the past few years, you will see that the average rate of inflation for private vehicles, including cars, are generally about 3% per annum. The base price of your bike may or may not go up at the end of every year by that amount, but it is for certain that if you finance your bike, the cumulative cost of your bike will go up by the interest rate set by your dealer or bank every year. If the interest rate is 3% or less, it is generally a no-brainer that financing it is a better option, since you can have your bike now and would not be paying more than what it is worth now in its future cost. And you still get to keep additional money in your bank for other purposes like investments. 4% would be more than it is worth, but still manageable. But anything more than 6% interest rate would be a bad financial decision. Next, you want to consider using the money for investment. If you are capable of dabbling in the financial markets or simply investing into ETFs and can get roughly 9% annual returns in dividends or 4 to 5% from corporate bonds, and that is being rather optimistic, then saving up and buying the bike fully in cash down the road is a far better choice, even if considering inflation. Not only that, but your savings are earning you even more money while you wait to make the purchase, and not financing means a positive cash flow that will allow you the flexibility of settling any financial emergencies that may pop up during this time. Another point to consider is your wants and needs. Financing is generally better reserved for extremely expensive purchases that you absolutely need, like a house for example, or is expected to give you returns on investments like starting a business. To most people, a motorcycle is neither necessary nor will it give you returns, and in fact will depreciate while you continue to pay an ever-increasing interest. If you are working as a motorcycle delivery rider, as is so common nowadays in the COVID period, or any other similar example, then financing starts making more sense as your use of the motorcycle is necessary to your livelihoods and provides a tangible return. One more thing to be wary of is to not get suckered in by low monthly payments. Some dealers or banks love to advertise low installments, but the truth is you should always pay as much as you can afford to every month. For a loan of $5,000 with an interest rate of 5%, for example, if you take a low $229 installment, you end up only paying $500 in interest over 2 years. But if you choose to leap out and take an $80 installment, your cost could balloon up to $1,750 in interest over 7 years. Next, you want to consider your current debts. Ideally, your total debt should be no more than 30% of your gross income. If you take home $2,000 per month after taxes and deductions, your monthly installments for everything, including mortgage of your house, credit card installments, etc., should not be more than $600. If you do decide to go ahead and finance a motorcycle, try your best to pay as much in down payment as you can possibly afford to minimize installments, and choose the shortest loan tenure that can comfortably fit into your debt allotment to cut out unnecessary interest payments. The choice between financing through a financial institution like a bank or an auto dealer is another one. In almost every case, it is always better to secure your own financing through a bank than rely on the auto dealer's financing, as they tend to be more vague on the prices in general. Usually it is always beneficial to cut out as many middlemen in financing, and in this case, the middleman is the dealer, as they have a backing from another financial institution at the back end. This is because while there may be some dealers that will pass through the bank rate directly to the consumer, most of the time they will tag a higher interest rate in order to scalp a profit from financing, as that is how they make money. Now that I've laid out all these considerations for you, what do you think? Do you think that in your own life it is better to finance your next motorcycle purchase, or is it better in your interest to just save up money, use it for a wide array of financial purposes like investment, and then buy the bike in full, in cash? Leave your comments down in the comment section below. And if you found this extremely useful in helping you in making decisions, remember to hit the subscribe button and the bell notification icon, and I will see you in the next video. Thank you and bye bye.